Excellent. We think the Fed is actually done raising interest rates. We think they hiked for the last time in July. So they have a monetary policy meeting in September. We think they'll be on pause. That's an agreement with what the market thinks. They have another policy meeting at the end of this year. We think they're not going to raise rates again. There's an open question as to what they're going to do with their dot plot. The August CPI print that was a little bit higher than expected probably means they're not going to change their dot forecast for the rest of this year or over the long term. So that means that I think investors are probably pretty well placed to take duration investments. We think that if the Fed is really done and has paused and this is the end of the rate hike cycle, usually high quality fixed income performs very well over the next few years. We think the Fed will eventually start to cut rates, likely in Q2 of next year. If inflation begins to soften closer to the 2% target, or the labor markets begin to or continue to weaken in the US, or financial conditions tighten more meaningfully. So different views. One, we're optimistic on the high yield market. The high yield market has strong fundamentals. Most of those companies turned out their debt when interest rates and spreads were a little bit lower in 2021. And so there's not a wall of maturities coming due. The liquidity risk or needs are pretty low for high yield US corporations, which is good. Fundamentals are strong, free cash flow is elevated, profitability is strong. It's tied to US consumption. For a lot of reasons, we're optimistic about high yield, even though spreads are below long-term averages. The US housing market, we feel, has strong fundamentals. There's not a lot of available inventory. And so even though mortgage rates are elevated and housing activity is likely going to slow, we're forecasting house prices in the US nationwide to increase modestly over the next 6 months. Fundamental risk is quite strong for US housing.